Welcome to the Deep Dive. This is where we take the complex stories, sift through the sources, articles, interviews, company filings, and pull out what you really need to know.
Giving you the context, the insight beyond just the headlines.
Exactly. And today, we're looking at a situation that definitely made headlines: PG Electroplast. Their stock took a big hit, down 10% one day, right after falling over 20% the Friday before.
Oof. Yeah, that gets attention. And the trigger was apparently a pretty shocking guidance cut, as the reports put it, from their own management.
Right. So that's our mission for this deep dive. Figure out what actually happened last quarter, what were the big challenges, and maybe more importantly, how do they see the path forward now? We're talking expansion plans, the whole picture.
And our main source for this is a detailed interview the managing director, Vikas Gupta, gave on CNBC TV18. So we're getting it straight from the top, so to speak.
Okay, so let's rewind to the start of the quarter. Things actually looked pretty good.
Surprisingly good, yeah. According to Mr. Gupta, back in April and May, the company was running flat out. More than full capacity was the phrase used.
Wow, okay.
Yeah, order books were strong. Forecasts from their big brand customers looked solid. Everyone seemed to be gearing up for a big rebound in AC sales in June and July.
Building on inventory that retailers had already picked up earlier, say from November through March.
Exactly. The pipeline was filling up based on that expectation of strong summer sales. Seemed like a reasonable bet at the time.
So full steam ahead, and then bam. What went wrong?
Well, the crucial piece was what they call secondary sales. That's the AC units actually selling off the shop floor, to you and me.
Right, the end consumer purchase.
Those just didn't happen in July and August like they expected, at all. So you ended up with this massive pileup of inventory stuck in the retail channel.
So the product moved to the retailers, but not from them.
Precisely. And all that stock just sitting there became a huge problem.
But here's something interesting. You mentioned other players in the cooling space, fan makers, cooler companies, even other AC manufacturers.
Yeah, reports suggest they were flagging a weak summer or a sluggish Q1 much earlier, maybe February, March timeframe.
So why the disconnect? Why did PG Electroplast seem to only realize demand fell off the cliff, as Gupta put it?
Yeah.
Later on, around June.
That is the million-dollar question, isn't it? It's possible their visibility was more focused on the orders coming in from the brands they supply.
The primary sales.
Right. And if those brands were still optimistic in April and May, placing big orders, well, PG Electroplast was busy meeting that demand. Maybe the signals from the end market, the secondary sales slowdown, just didn't filter back fast enough or strongly enough.
Until the channel was completely choked.
It seems that way. And the severity really hit home. Gupta apparently said it was the worst summer for AC sales since 2008.
2008,
Yeah.
That's a major benchmark. We're talking global financial crisis level impact on demand.
It underscores just how sharp and unexpected the downturn felt to them. Not just a blip, a proper shock to the system.
Okay, so demand collapses, inventory piles up, let's talk money. The immediate hit was the guidance cut, right?
Yes, the big one. They had guided for a net profit around 310 crores for the full fiscal year.
Which sounds pretty decent on its own.
It does, but the sting was in the margins. They had to cut their margin guidance by 125 to 150 basis points.
Okay, break that down. Basis points.
It's just 0.01%. So we're talking a 1.25% to 1.5% cut in their expected profit margin for the year. And in a manufacturing business, margins are everything. That's a significant hit.
Yeah, and Gupta apparently pointed to three main reasons for this squeeze.
That's right. First off, finance costs. All that unsold inventory, it ties up huge amounts of working capital, money they need to run the business day to day.
So they were cash strapped.
Effectively, yes. To manage cash flow, they had to resort to a lot of discounting and factoring.
Factoring. That's like selling your invoices at a discount to get cash up front.
Exactly. You get the money sooner, which helps liquidity, but it costs you. It eats directly into your profits. Both the discounting to move stock and the cost of factoring hit the bottom line.
Makes sense. What was the second factor?
Seasonality. The AC business is famously seasonal. You make your money in the peak summer months.
April, May, June.
Usually, yes.
Yeah.
But this year, the peak effectively got cut short when sales died in July and August. So the number of lean months increased.
And you still have all your fixed costs during those lean months, right? Factory rent, salaries, machine depreciation.
Precisely. Those costs don't go away just because sales slow down. It's what they call operating leverage working against you. When sales are booming, high fixed costs mean profits soar, but when sales slump.
Those same fixed costs drag you down hard, Like that restaurant example you used, fully staffed for a rush that never comes.
Perfect analogy. And the third hit, good old rising input costs.
Ah, always lurking. What specifically?
Gupta mentioned the dollar exchange rate, meaning imported components got more expensive, and specifically copper tubing, which is a key material in ACs.
So a triple whammy. Higher financing costs, the leverage from seasonality turning negative, and rising material prices. Ouch.
Yeah, it paints a picture of intense pressure on profitability in that quarter.
So the immediate firefighting task must be that mountain of inventory. What's the plan there?
They're aiming to get inventory levels back to normal, what they consider about 1 month production, by October or November.
How? Just discounting heavily.
Presumably that's part of it, but they also said they're working closely with their customers, the brands, planning for the next season to manage the flow better, trying to avoid a repeat performance.
Okay, makes sense. Now let's shift gears slightly. Beyond the operational and financial mess, there was also this optics issue, shall we say, around the promoter selling shares.
Ah, yes, the stake sale. That definitely raised some eyebrows with investors.
Understandably. The timing looked awkward. Promoter shareholding went from over 49% in March down to under 44% by the end of June.
Right when the business was apparently hitting this rough patch, investors felt like maybe they didn't get a heads up or that it signaled a lack of confidence from the inside.
So what was management's explanation for that? 'Cause the timing does look bad on the surface.
Their explanation hinges on when the deal actually happened. They clarified the block deal took place in May.
Okay, May. And back in May.
According to them, back in May, they were still running at more than our capacity. From their perspective at that moment, sales were still looking good based on the orders they had.
Ah, so the sale happened before the scale of the July-August demand collapse became clear to them.
That's the narrative. They stressed that the sale does not change our outlook on the business and insisted the long-term outlook remains intact.
They also made a point about commitment versus percentage, right?
They did. They argued that their dedication to the business isn't just about holding over 50% of the shares. They pointed back to December 2024 when they did a big QIP.
A qualified institutional placement, raising money by selling shares to big investors.
Correct, a 1,500 crore QIP. And during that, their stake also dipped below 50%. But they did it, they said, to fund growth, to build the company.
So the argument is, we've diluted below 50% before for strategic growth reasons. This recent sale shouldn't be seen differently, and 43-odd% is still a very significant stake.
That's the gist. They feel it's a very decently positioned stake compared to peers, and their focus is on long-term value creation, not just clinging to a specific percentage number.
Okay, so what about the future? Will they buy back shares or increase their stake now that the price is lower?
Well, there's a regulatory hurdle first. The rules around that block deal apparently lock them out of trading for 6 months, starting from May 26th.
So nothing until late November at the earliest.
Right. But Gupta did say that after that period, if rules allow, they would definitely participate and look to increase their stake.
But no company share buyback planned.
No, he explicitly said a buyback is not a scope they're considering. Their priority, he emphasized, is investing cash back into the business, building our capabilities through their ongoing capital expenditure plans.
Which brings us nicely to the path forward. Despite this really rough patch, they sound pretty bullish on the long term.
Very much so. The message coming through loud and clear was, the long-term story for this business looks very robust. And crucially, one single week summer cannot define the destiny of the company.
Strong words. Are they backing that up with action?
It seems so. They listed several ongoing initiatives. They're executing the CapEx guidelines from that big QIP fundraise.
So investing in plant and machinery, presumably.
Yes, and also pursuing new product diversification, working on new launch of product platforms, and actively building up new capacities. It sounds like the growth engine is still meant to be firing, despite the Q1 sputter.
What about that big compressor facility joint venture? That's been talked about for a while, hasn't it? Any update there?
Yes, that came up. It's definitely been anticipated, and yes, it's faced delays. The latest is the building is actually constructed.
Okay, progress.
And they've evaluated the quotes for the machinery, but the holdup now is apparently their Chinese partner needing certain approvals at their end.
Ah, external factors. So, timeline.
They're hoping for some clarity by October. But realistically, Gupta suggested FY27, the fiscal year, starting April 2026, is probably a safer timeline for it to actually kickstart operations. So, still a way off.
Right, something to watch, but not immediate. Okay, so even with that delay and the awful Q1, they're sticking to the full-year profit guidance, that 310 crores number.
Remarkably, yes, he stated they do not see any downside risk to that guidance as of now.
That's bold, given the margin pressure we discussed.
It is, and he even added that historically, they have been always trying to outperform the guidance. So projecting confidence, maybe trying to signal that Q1 was an anomaly they can recover from within the year.
And part of rebuilding that confidence is talking to investors directly.
Absolutely. They mentioned actively engaging with our long-term investors to explain the situation and lay out how they see the business developing over the coming months and years. Communication is key when you've had a shock like this.
Definitely. So if we pull back, what's the takeaway here? We saw a company hit by a sudden, sharp demand drop, leading to inventory chaos and margin pressure.
And a share sale that, timing-wise, didn't look great, even if the explanation makes sense chronologically.
But through it all, management is sticking to its long-term expansion plans, sticking to its full-year guidance, and saying, this one bad summer won't define us.
It really highlights that tension, doesn't it, between the operational realities of a tough quarter, the worst since 2008 apparently, and the strategic vision for the future, that operating leverage we talked about.
Yeah. Great when sales are up, brutal when they fall.
Exactly. It shows how even a company running full tilt based on customer forecasts can get caught out badly when the final link in the chain, the end consumer, suddenly stops buying. It's a lesson in the fragility of forecasts in seasonal markets.
Absolutely. And it really makes you wonder, doesn't it, when you face that kind of unexpected storm, whether in business or, even personal plans, what does it really take to ride it out?
Yeah.
And not just survive, but actually stick to your long-term vision and maybe even come out stronger?